It's a beautiful morning here in Northwest Arkansas. It's about, say 65 degrees. The sun's not quite up yet, but it's about to come up. We're going to head down. It's also a beautiful morning to go fishing and to talk about accounting. So today we are going to talk primarily about standard setters. So when we talk about standard setters, when we finished up last time, we talked about how we needed standards in order to provide some consistency, primarily for comparability and to ensure that everyone is using the same definitions. So when we say an asset or we say cash, receivables, inventory, it helps if one company says their inventory is equal to the same thing another company would say that their inventory is. So because of that, we have standards, generally accepted accounting principles that companies are going to follow. Those need to be promulgated by certain entities, basically, or issued by certain entities, and then generally also enforced. If no one's enforcing them, it's not going to do you much good to even have them. So we have several entities involved in this process. Primarily, we have the Financial Accounting Standards Board, or FASB, and we have the SEC, or the Securities and Exchange Commission. The Securities and Exchange Commission is a government entity. They were set up as part of the 1933 and 34 Acts, and they were put in charge of overseeing and enforcing the accounting done by public companies. So what did public companies have to produce and supply to their investors? Briefly, the FASB is a nonprofit organization that sets the actual standards. The SEC primarily is involved with enforcement. The SEC, for the time being, has actually given over its ability to write standards to the FASB. They've decided it was not in their best interest to actually write the standards, although they do have quite a bit of influence over them. But they do enforce those standards, and I would say they enforce their interpretation of those standards on public companies. So that's a quick overview. We'll delve a little bit more into the rest of the sections here in a minute as we finish up our walk down to the river. Well, welcome back. We're down here at the river. It is a beautiful morning. The sun is getting ready to rise over there. We're going to do some fishing and continue our discussion about accounting standard setters. So, Financial Accounting Standards Board is the organization that is actually tasked with developing accounting standards. So, the FASB has three parts to it. The Financial Accounting Foundation, which is a kind of a base organization. It selects members for the FASB, funds all the FASB's activities, and exercises general oversight over the FASB. Now, underneath the Financial Accounting Foundation is the Financial Accounting Standards Board. The Financial Accounting Standards Board, its mission is to establish and improve standards of financial accounting and reporting. That is what it primarily does. It functions primarily through the use of a board. So there's a board that sets the final standards for the FASB. And within that, the next level is kind of the Financial Accounting Standards Advisory Council. Now, this is not the board, it is a council. They provide insight on major accounting issues. The council includes people from all different areas, users of financial statements, preparers of financial statements, auditors of financial statements, are all involved in even in the formal process here. So what that formal process looks like. Now we're going to focus primarily on the Financial Accounting Standards Board because they're the ones who actually set the standards. Their mission is to establish and improve standards of financial accounting and reporting. So there's a small number of members. There's only 7 members on the board. The members are accountants. I believe there's basically what you would consider like a professional investor on the board. There's also an academic on the board right now. So they are full-time members. They are paid for their membership, and they set standards. they're independent. They must leave their former jobs. So we don't have, say, partners at large public accounting firms sitting on the board. Now, we may have former partners at large public accounting firms on board, but they are not currently members. This is their primary job, and they should be independent. So they're not out there to for the agenda of a specific organization. And it's supposed to have broad representation, as I kind of mentioned before, with numbers of the different types of people involved in the process. So what does the process for actually setting the standard look like? We've talked about who does it. So what does the process actually look like? So it's actually a pretty lengthy process. It can take years to come up with a new accounting standard. And I've never seen it basically happen for a full standard, happen in less than probably 18 months, and that might even be on the short side. So it starts with basically identifying an issue. Basically, is there something that needs a new standard or that we need to address? A lot of the more recent issues have been around how we measure things, whether we use fair value or historical cost, and it's been a shift over the last 15 to 20 years. There's been a lot of discussion about consolidating different entities, things like that. Technology companies have introduced a whole new set of issues because inventory is a little weird, revenue is a little odd, so new standards have come out because of that. So they identify kind of an issue, and they develop preliminary views. So what is it? What are we looking at? How does it fit within the conceptual framework that we've already talked about? They then work as a board, and they develop, they take outside comments, extensive outside comments. You can write letters to the FASB commenting on basically a new issue, and that happens all the time. I've been part of writing letters to them as well, and it just kind of says, okay, well, here's our issue. What do you guys think? Lots of people write comment letters on that. The FASB then takes their preliminary views, and they develop an exposure draft. The exposure draft is kind of like, here's what we think the statement's going to look like after all the work we've done. Here's what the statement will look like. Now, it's not final yet, it's exposure, so they put that out and lots of people comment on the exposure draft. They have an opportunity to go back and revise the exposure draft. I would say at that stage, it's not frequent that there's major changes, but there have been in the past as different constituencies get involved and realize the impact for their business or their financial reporting. And once the exposure draft has percolated a while and they've figured out that it's pretty decent or it accomplishes what they want to, then they issue their final standard. Now, the final standard comes out as a update to the codification. The codification is where all the financial standards are put in an organized format. An exposure draft, a new standard may affect multiple areas of accounting. So it could affect a piece of revenue and a piece of assets or accounts receivable recognition. Or the reporting aspect, all different pieces, all that get impacted by one standard. So that standard is what needs to kind of get updated into the codification. So we have several types of standards. Types of pronouncements, we have the accounting standards update, that updates the codification, and then we have concepts, which are kind of say broader releases that talk about the underlying underlying foundations we have. They are not considered GAAP. Get out of the sun here. They are not considered GAAP, but they do provide a basis for GAAP itself. So the codification, as I mentioned before, is just an organized format of all the different standards. That's available on the FASB's website. There is an academic license if you want to take a look at it. The way it's organized is by topic area. So for instance, receivables, which is topic 310, has multiple areas. So such as overall and then reporting or valuation, or what do you do subsequent reporting for receivables, like after you've issued the receivable, what's it look like? So that's just generally how the codification is organized. Now, we're going to take a break there. The sun's coming up. I'm getting put into the sun right now. It is probably doing some havoc on the rest of the shadows in the video. So with that, I will pick this up in a minute when we have a chance to move, and we'll continue on. Okay, so this is a little bit better spot out of the sun. Going to continue on. We just talked about codification. So the general accepted accounting principles, codification, a couple things to keep in mind here. The codification, you kind of take it for granted. You will, for sure. You will have had it your entire career. When I started, we had no codification. When I started in accounting back in basically 2000, we had no codification. The accounting statements were in standards. So there were 100 and some odd standards when I started, as well as a bunch of other older stuff from previous organizations that were considered GAAP. So there was this giant GAAP hierarchy about what standards were GAAP and what standards were old and superseded by former GAAP, and if two standards contradicted, which one was the one you followed. That was a disaster. We don't have that anymore, thank goodness. Now we have the codification. Everything is in one place, it's authoritative, it's organized, so that if you want to know how to account for receivables, you just go to section 310, it talks about how you account for receivables. Overall, how you report receivables, everything's in there, all organized. It's really handy. You will take it for granted, and that is technology in terms of innovation making your life easier. So that's the codification. Now, as we move on, now it's easy to step back and say, oh, this is a great process. We should have wonderful standards. Look at all the input we get. Well, that's kind of true, but there are some major challenges to developing standards. Not everyone agrees on how you should account for things. I don't know if that should surprise you. Believe it or not, there's disagreement even in accounting. It's impossible. As my father-in-law used to tell me, does 2 + 2 still equal 4? Is what he would ask me. And he would ask about how my job's going. I said, yes, but we still don't know when to add 2 + 2 together. So anyway, with that said, there are many disagreements in accounting in terms of how we account for things. It has a huge impact on companies and how they account for things. If a company is doing something and a change in accounting standards would make them recognize an expense sooner, they generally aren't going to like that, even if it, from a theoretical standpoint, would provide better information. Back when I first started in accounting, there was a huge debate with stock options. So stock options are generally used as kind of like compensation or payment for something. So instead of actually paying you in cash on a startup, I'll say, well, you can have the option to buy my stock anytime in the next 10 years for, say, $5 a share. That is an option. It was given to employees. Well, they didn't used to be expensed. They just kind of like, well, it's just an equity transfer, or there's no value because whatever, that's the price of the stock today. So it actually, the option has no value. But anyway, FASB came out with a standard that would expense stock options. Companies, particularly tech companies, pitched a huge fit, and when FASB wasn't willing to listen to their complaints, they went to Congress, and Congress basically said, you can't do that. Well, eventually it became obvious that that was still the best accounting, believe it or not. But when Congress says something, it does not make it the case, especially when they talk about accounting. So it ended up getting put forth, but it was delayed because Congress got involved. But that brings us to the point that there are many constituents who have a vested interest and want to see certain accounting standards enacted or generally not enacted. This involves government agencies, CPAs, auditors. Auditors have to audit these things. So if there's a standard that auditors look at and is like, there's no way we can verify that in any credible manner, they're going to push back a lot, and they do. And that generally helps. It helps the verifiability part. However, it does also simultaneously reduce some of the information you can get because the auditors need it to be verifiable for them to audit it. That is kind of a cost of our system. And that's why we have so many other sources of information, as we talked about last time. So the government, as I mentioned, can get involved. Management of the company, investors, different investor groups. So hedge funds might want one thing, whereas mutual funds want a different thing. Individual brokers might have a different perspective. All of these constituents have their perspective on what they want. They make sure that those are communicated to the FASB, and to the extent possible, incorporate it in the standards. So, quick highlight, I talked a little bit about stock options. More recently, somewhat recently, it was in like, 2008 or 9, during the financial crisis, again, there was a standard coming out that was going to require banks to fair value some of their assets. Well, these assets in 2008 suddenly lost a massive amount of their value. If you were to fair value them, they could have taken up to, like, say, a 90% hit on some of these assets, depending on what they were. And now you could argue that those weren't good market values because there wasn't a very actively traded market. However, that was the market value. Well, banks did not like the idea of their capital getting demolished. They were already getting hit pretty bad in the financial crisis. So FASB didn't budge. The banks went to Congress. Congress actually made it illegal for banks to fair value some of their assets for that period of time. And there's reasons for that. I'm not saying all those reasons are invalid, but from an accounting standpoint, that's not good. From multiple levels. So what that did was, during a time of a financial meltdown, it reduced the information available to investors for them to use to help value a company. So if we go back to the market for lemons, if I can't tell the difference between a good bank and a bad bank because all their financial statements use historical cost or some hybrid of historical cost, and it doesn't allow me to identify banks that have really bad assets, am I going to invest in banks? Because I don't know. I'm going to assume they're all bad, which is essentially what happened. The banks' market values were demolished during this time because investors could not identify a good bank from a bad bank because banks weren't fair valuing their financial statements. So investors pitched a huge fit about this, basically saying that Congress just took away a big piece of information, a very important piece of information at the time, to help value and determine which banks are worthwhile holding, which ones shouldn't be. So with that said, there is also what we call an expectations gap. That is the difference between what accounting actually does and what people think accounting does. So most people don't really understand what accounting does or what accounting is. Going back to my 2 + 2 = 4 illustration, accounting is not math, FYI. So there's an expectations gap. Accountants do not create things. That is a big concern. And that's where you see most of this expectations gap, is that accountants create things or take them away. Accountants do not create anything, and they do not destroy anything. They report things. Back to the definition of accounting: identify, measure, and report. So I've seen articles where people bash accountants for creating massive liabilities and putting them on the balance sheet and causing the company or the government or whatever to generate a loss. Well, guess what? Accountants did not create those liabilities. Management did, or government organizations did. All the accountant is doing is looking at what the company did, the economic activity, and saying, well, as part of that, a liability was created and we need to report it. And frankly, it doesn't matter whether they like it or not. Accountants do not create, they do not destroy. Accountants report. That is the goal. If accountants start creating or destroying, that's usually called fraud. We try to avoid that. So some challenges we run into with accounting. So there are clearly challenges as we develop good standards. So non-financial measurements. Accountants are really good at financial measurements, not so good at non-financial measurements. So non-financial assets being one big thing. Forward-looking information. Accountants really don't like forward-looking information, although it's baked into so many pieces of the financial statement. However, accountants aren't good at providing forward-looking information. It's not verifiable. It's not very reliable. We don't like it, but it provides good information. Soft assets, intangibles, like say patents or trademarks, soft assets. Timeliness. Obviously, we want financial statements to be available as soon as possible. However, we also want them to be verifiable and defensible and correct and not biased, and that takes time. So we're constantly fighting this timeliness problem and keeping them understandable. Well, it's easy if you have 5 years of education and 10 years of experience to think accounting should be one way, and then you try to get an investor who has taken 2 accounting courses as part of their finance major and hardly can read the footnotes to understand it can be a bit of a challenge. So we also have international standards which have come out. They vary somewhat from GAAP, from US GAAP, but they're similar enough that we can use them all. And you'll learn the differences as you work through your career, but they're not insurmountable. There's just a handful of items, but there has been some move to streamline and keep those as consistent as possible. I would say, depending on the time frame, that effort and desire to keep them similar fluctuates between who's running the show. So, and we always have ethics. That's always a problem. Regardless of what we tell people they should do, what they do can be different, and we can have ethical violations. Accounting does not solve ethical problems. It just gives us a benchmark to know when someone's generally not being ethical. So that pretty much wraps up this section. Hopefully you've enjoyed it and have learned something. We will move on to the next section tomorrow, which is the conceptual framework. The conceptual framework forms a great foundation on which we base our standards and how we evaluate whether we have a good standard or a bad standard and whether we should have a standard at all. So with that said, have a great day. God bless, and I will talk to you later.